Hi everyone and welcome back to ABG's Investor Days. My name is Anna Danfors and I am an equity research analyst in our retail team here at ABG. With me today I have the pleasure of presenting Fiskars Group and CFO Jussi Siitonen and also Investor Relations Director Jussi Essi Lipponen. So we will start off today with a company presentation, and then it will be followed by a brief Q&A. So with that being said, please go ahead with your presentation, Jussi.
Thanks. Okay, now hopefully you can hear me. So hello everyone. So in the next 20 minutes, I will walk you through first the group background, what is Fiskars all about, then focusing more on our new strategy. We came up in November last year with the new strategy, including the new financial targets. And then thirdly, I will walk you through our Q1 result and especially full year outlook. So let's move to the next slide. So very shortly, what is Fiskars all about? We are the oldest Finnish company, established 1649. We operate in more than in 30 countries. We are focusing on three main segments there. Terra, which is gardening, landscaping. Detta, which is very much tableware, art glass and the likes. And then Crea, which is all about scissors. We operate mainly through wholesalers. Our own D2C, including both e-commerce and own retail, is roughly 20% of sales. We have more than 350 owned stores, mainly Iittala branded stores. And last year, we were a bit more than 1.2 billion of sales and 12% EBIT. Let's move to the next slide, which gives you a bit more in detail our brands. So as I said, we have a world-class brand portfolio. You can see here on the first row, our biggest brands there, Fiskars of course, not only the company name, but it's also our main brand. Royal Copenhagen, Iittala, Gerber, Moomin by Arabia, Waterford, Wedgwood, Arabian, Hackman, those are the big ones, what we have in our portfolio. So we have very strong global portfolio in our hands. On the next slide, please. You can see the categories I already briefly referred. So Detta, which is a bit shy of 50% of our sales, is very much tableware with all brands like Iittala, Waterford, Royal Copenhagen, Wedgwood and Moomin. Also drinkware and interior design is included in this category. Last year, this was highly profitable. We were talking about roughly 15% EBIT for us, and as I said, a bit shy of 50% of sales. Terra, which is very much focused on the US market. USA is the biggest for Terra. That's about gardening, then outdoor both with Fiskars brands and also with Gerber brand, and then watering. And later in this presentation, you will find out that we have actually divested part of our watering business already. This is about the same size with Detta, so roughly 43% of sales, and also at improving profitability glide path there. The smallest category, Crea, including the famous orange Fiskars scissors and creating tools there, as well as cooking. And this is 14% of our sales. Actually, Crea is our most profitable business, over 20% EBIT margin. So that's very briefly about what this company all about. Then more focusing on our new strategy. And for the context here, for the background, if you go to the next slide, please. Here what you can see is our top line development from the last 4 years there on the left. And as you can see, we had a longish period of no growth. Actually, top line was very flat, even declining somewhat there in 2019. And then it was decided that the new strategy, that needs to be growth strategy. We saw some good growth already in 2021. So top line came up on currency neutral basis 14%, and we have continued that growth track also now in 2022. In the first quarter, we were up 13%. Together with the top line growth, we have also succeeded to improve our gross margin. Gross margin in our businesses is the driving factor of continuous sustainable profitability there. So last year we succeeded to improve gross margin by 240 basis points there. That's mainly through commercial excellence topics. I will go back to those a bit later. And then also we succeeded to keep our operational expenses quite flattish, leading to the strong improvement there on our EBIT margin. We came up 2.5 points versus the previous year there at 12.3. So that's the background where the company started renewing the strategy in 2021. And then as said, we came out with our new strategy in November last year. And on the next page, you see which are the key factors of our new strategy. As said already, this is a growth strategy, meaning that we have a clear strategic focus on growth and different transformation levers what we have. The logic of the new strategy is that we have defined the winning brands what we have. We have 5 winning brands: Fiskars, Iittala, Royal Copenhagen, Gerber, and Moominpie Arabia. So those are the ones where we believe that we still have a lot of growth, but organic growth potential. We also believe that the current profitability level, whilst is good already now, we still have room for improvement in those 5 brands. On winning channels, it's very much our own e-commerce and our own brick and mortar stores. We believe that they will take roughly half of the all growth what we have in the company for the next 4 years until 2025, which is our financial glide path for the future. As said, they are only 20% in our sales at the moment. It's practically all about Vita business. So tableware and all these categories are mainly sold through in our own channels there in Vita, whilst own e-commerce, own retail practically does not exist yet in Terra and Crea. In Vita, it's roughly almost half of the business already. On countries, we have defined 2 winning countries, which is US and China. US for the good reason that we already have a strong business there. It's a bit shy of 40% of our total net sales at the moment. And that's still the biggest consumer market, and our brands are well presented in that market. China is another winning country what we have in our portfolio. Strong growth there. Last year we doubled the business. This year first quarter we were up 1.5x versus last year, and it's a market where we have good growth opportunities, especially with Vita brands. Then we have defined 4 transformational levers, and the one where we see that we have the most low-hanging fruit is commercial excellence. This includes everything from price increases, from in-store excellence, both offline and online, and all these kind of, I would say, almost like no-brainers, which company did not have in place in the past. And now when we have started to implement this kind of good commercial excellence practicalities there, we have seen that already now in our gross margin improvement. Direct to consumer, I already mentioned, USA and China. These are the ones where we believe that we have biggest investment opportunities also in the future. And when I'm talking about investment opportunities here, I mean organic investment opportunities. And then we have defined 4 enablers: people, digital, which is the one which is contributing very much to D2C growth, but also commercial excellence there. And that's the one where we have invested most in the past 12-15 months. Innovation and design and sustainability are then the remaining 2 enablers what we have in our portfolio. Then also what we said when we came out with the new strategy last year was that we are now committed to report where we are with these transformational levers. So if you go to the next page, You can see that this is the situation after Q1. So commercial excellence, they're the bellwether brands, what we have in our portfolio. We were able to mitigate the negative impacts of cost inflation in 2022. We did that already in 2021, and now we have continued mitigating it after Q1. We had improved gross margin in Q1. I'll get back to that later, explaining also the drivers there. And we believe that on long-term basis, we can continue improving our gross margin. We have set the targets to gross margin that we should be there at 47-48% by 2025, which is our long-term planning horizon at the moment. And currently we are there at 46 plus levels. So we still have roughly 2 percentage point room for improvement in that area. And direct to consumer, so D2C overall was up 14% for Q1, whilst the whole company was 13.5%. And this time it was very much driven by retail. So retail growth was 17% in Q1, and e-commerce, I would say only 7%. There we had some technical setups we just implemented in Q1, and they were not yet fully up and running as we speak. USA, as said, the biggest single country for us, the biggest single market for us as such, up 16% there. And then China, as said, 1.5x in Q1. And even though we have seen those challenges there due to these lockdowns, we see that underlying demand does exist and it continues. China continues delivering strong growth also for this year. So that's about transformation levers. Then moving to our long-term financial targets, if you go to the next page, please. So together with the new strategy, we also set 4 new financial targets for the company. On net sales, the target is now that we need to deliver organic, FX neutral, mid-single digit growth, quarter after quarter, year after year. And you can see our track record here. So 2020, we were a bit below this kind of mid-single digit level. Last year, over 14% growth. And now if we take trailing 12 months at the end of March, we were over 10% growth. On profitability, the target is set so that EBIT margin, excluding one-offs, should be at mid-teen, roughly 15% by end of 2025. Last year, 2021, we improved with 2.5 points, as I mentioned, and now we have continued improving gross margin. Last 12 months at the end of March was 12.4. It was only, I would say, only 30 basis point down versus respective period year ago. And there our target is to make this roughly 15% by 2025 steadily, so that it's not a hockey stick, that all improvements is coming late in our glide path, but we need to be able to improve it steadily year after year. On cash flow, the target is set free cash flow net profit over 80%, and this has been quite volatile through the past few years, very much working capital related. Currently, we are well below the target for last 12 months trailing, but there are certain reasons mainly relating to our investments in inventories to be able to deliver the second half this year, and I'll get back to that also later. And then balance sheet, we have very strong balance sheet. The targets how we have set the balance sheet strengthness is that net debt last 12 months EBITDA must be at or below 2.5x. And as you can see here, we are well below that target. So we do have firepower on our balance sheet for future growth. As said, this is growth strategy and it's organic growth strategy, which means that we are mainly using our balance sheet as well as cash flow to secure our organic growth. But with a balance sheet like this, of course, we need to be mindful that if there are good opportunities in the market for acquisitions, we need to be mindful also with those. But as said, currently we are only focusing on organic growth at the moment. That's very briefly about our strategy and financial targets. Then moving to our Q1 result. And if you go to the next slide, some highlights here. So Q1 was our 8th quarter in a row with top-line growth, year-on-year top-line growth. We also continued improving our profitability, mainly through the improved and higher volumes there. And then we kept our outlook unchanged. We are only giving a full year outlook, not quarterly outlook. And what we reconfirmed was that our comparable EBIT will improve from 2021 level. Then on next slide, you can see our quarterly top line improvement, what we have. So top line up 13.5% organically. We have some divestments there earlier this year. So we divested a US watering business, which is very low margin business for us. And excluding that one, you can see how we ended up with this 13.5% top line growth. The growth was highest in our Terra category, gardening, landscaping, watering. That was mainly due to the reason that in the US we have a strong selling period in early Q1, when all big retailers there, they built their inventories for the coming season, and of course we were the one benefiting for that inventory build. Next slide shows you our EBIT improvement. Typically, as you can see, Q1 is the strongest period for us, and that's due to our seasonal factors. What we have this year, we continued improving it by over 5 million, and that's pretty much driven by Terra volumes, what I already explained. So that was the main reason there, which continued improving profitability. The next slide, more in detail there about Q1, and a couple of call-outs here. First is gross margin. So gross margin, whilst it was up 190 basis points versus last year, roughly 3/4 of that improvement came from structural changes. So when we succeeded to divest our US watering, which was very low margin business, it immediately improved our gross margin. And most of that improvement, what we had at the group level, came from these divestments. At the same time, we succeeded to mitigate the cost inflation. The cost inflation, what we saw in Q1, was roughly 10%. We talk about 17 million, increase in cost of goods just due to the input cost inflation. Roughly half of this inflation came from logistic, 1/4 from raw materials, and 1/4 for finished goods. So that was the main structure of this cost inflation. And that's what we succeeded to fully mitigate now in Q1. Then operational expenses up 14 million, out of which roughly one third, 5 million, was those investments what we had in digital capabilities, building up also our own e-commerce there, and then investment in our own retail growth. So those were the biggest investments what we had. Also in Q1, we announced in early March that we are totally walking away from Russia, and we took some one-off due to that one in Q1. So we broke down all the assets what we had in Russia, approximately 10 million there. Russia overall was very small business for us. We talk about roughly 1% of company sales, and we are able to catch that up elsewhere in the markets. So therefore, divesting Russia business totally was not such a big issue for us. Then on Q1 cash flow, a couple of words about this. If you go to the next page, please. So as said, Q1 cash flow is always low. Q1 is always a low cash flow season for us, and this year it was even more negative versus last year due to the fact that we invested in inventories, and then also higher volumes what we had. They went to receivables, and now as we speak, we are repatriating those receivables there. But what we wanted to secure was that we do have availability for the coming seasons, because what we have found out is that retailers, well, consumer is buying what he or she can find on the shelf, and we need to be one who has capabilities to deliver. Then on next page is about balance sheet. So whilst we continued investing in inventories, you can see here roughly 50 million growth on inventories versus last year, same period. However, the true number is even higher because what we need to remember is that we divested US bordering and there we had 30 million inventories. So organic inventory growth is even higher. At the same time, even though return of capital employed is not our one of our key financial criteria or key financial metrics we are following or setting the targets, you can see that whilst we continue investing in inventories, we also succeeded to improve our capital turnover and capital efficiency overall, and then improve our return on capital employed. The last slide here is about our outlook. I already mentioned that we reconfirmed our full year outlook, so that we expect our EBIT in absolute terms to increase from last year level of 154 million. Having said that, this year will be a bumpy road, so the target is set for full year and we are comfortable with that one. But we see that there's a certain volatility in the market, mainly due to the reasons that the recent inflations what we have seen is somewhat more what we expected for the full year. And the mitigation actions we put in place in February, in March, they start impacting positively on our profitability in the second half this year. So we have somewhat empty period here with those recent actions. When it comes to full year inflation as such, we expected quite high inflation and started to acting accordingly already late last year. So the only addition there is what happened since late February, early March, when the war in Ukraine started and all that kind of implications. So that's something we have recently mitigated. That's very briefly our presentation about Fiskars strategy, financial targets, and then Q1 and full year outlook. I think it's now time for Q&A.
Yes, perfect. Thank you very much, Jussi, for a great presentation. And I'll start off with some few questions here. So touching upon again what you mentioned now in the end regarding volatility in the markets, many companies are experiencing a declining interior interest for the home, and we have also seen a consumer confidence that is at the same bottom levels that we saw in back in April 2020. So how would you say that you are experiencing the demand, and how good is really your visibility ahead?
Yeah, I would say that our visibility to market is not any better than anyone else in this industry. What's good for us is that our portfolio is truly global, and it's so well split between US, Europe, and now increasingly also in Asia, that we have a good offsetting items there. And this consumer demand, what we have recently seen, varies still a bit region by region in our categories. So what I said already, that current quarter seems to be very pumpy in this respect. There are several reasons still to believe that in US, in our categories, garden and the likes, we see some growth. Okay, there has been quite cold start for the season, and therefore some delays there when it comes to point of sales data. But we believe it's gradually coming. In China, even though the lockdowns there, we see that underlying demand does exist, and that would help us in future. Where we have had seen most challenges is our home markets here in Nordics. In Sweden, we have some challenges there, mainly due to the fact that our big customers, they build their inventories late Q4, and now the full Q1, early Q2, they have tried to get inventories at the right level. They are getting there, that's what we can see, but that's why our selling has been quite challenging there. And in Finland, there we have seen that consumer sentiment being a bit gloomier than elsewhere. And of course, Iittala being the biggest brand in Finland for us has suffered somewhat on that one. But overall, this, I would say, multi-category, multi-regional portfolio, what we have, helps us a bit in this situation.
Right. Thank you. That's assuring to hear. And one of your key strengths that we have seen has been your gross margin, as you touched upon, and we have not least seen proof of evidence in terms of when we have seen a surging cost inflation, and you have actually been able to protect this quite well. So could you perhaps break down the like key driver or components behind this, and also are you taking any specific actions to protect the gross margin also going forward?
Yeah, we started late Q3, early Q4 last year when we saw the existing inflation there. So we started with price increases, especially in Vita business. And now Terra has followed and Crea has also followed that one. So I would say that has been this kind of short-term medicine what we have had against inflation, the price increases. But of course, we need to understand that price increases also include then volume risk, and you need to have a better proposal to the consumer, to the customers, combined with the price increases. So price increases is the first, but of course it won't take us through the whole inflation if this continues. Then the basic things, as I mentioned, regarding consumer or commercial excellence, there are the ones. So our commercial excellence level has not been there where it should be, and therefore easy things, just starting from in-store excellence, how we look and feel in the stores, how we are now increasing traffic in our own e-commerce, our own retail stores. These are these kind of simple things we have put in place, and they are now yielding back. Then also our continuous improvement program in our own manufacturing. Own manufacturing is it's roughly 50-50 between sourcing and own manufacturing. So those actions we have put in place in own manufacturing, simplifying the production lines and the likes, they are also now yielding back when it comes to inflation mitigation.
I think we have time for one more last question before we have to finish up here. So you presented, as you mentioned, your new long-term financial targets in November 2021, and also your updated strategy. So how would you say that your execution is going on this so far, more from what you have mentioned in the presentation? And as you mentioned, we, for instance, saw that you divested your North American watering business, which, from what I understand, had below group profitability.
I would say on 80-20 basis, we are there where we plan to be at this stage when it comes to execution of our strategy. US watering is a good example. It was a mass market with very low gross margin, and we are not the ones who can be excellent in that kind of business. So we are in high premium brands, and therefore the model is built for that one. So that's a good example of divesting portfolio when it doesn't fit to our strategy. But as said, overall, I would say that all 4 transformational levers are where they should be. Okay, we have some seasonal topics there like COVID in China and the likes, but on longer term, we believe that we are on track. Then on profitability or financial targets, what we have set as a part of the strategy, there we continue improving profitability. Top line is there. We know that cash flow is getting there, and balance sheet is already at very much targeted level, or even much stronger than expected or planned in our financial targets. So its focus is now to continue improving profitability sustainably.
Great, thank you. Looking forward to keep following you and your journey ahead. So with that being said, we have to unfortunately round up here. So thank you very much, Jussi and Essi, for presenting and answering our questions. And thank you everyone who listened in.
Many thanks. Thank you.
Thank you.